Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of discussion is top 5 legit ways to pay 0% federal taxes on the income in US in 2025. So here we have 7 tax strategies and the concepts you have to know. Tax planning is the analysis and the arrangement of person's financial situation to maximize tax break and minimize tax liabilities legally and efficiently. So tax rules can be complicated, but taking some time to know and use them for the benefit can change how much you end up paying when you file. Here are some key tax plannings and the strategy concepts to understand. So, first of all, is understand your tax bracket. You can't really plan for the future if you don't know where you are today. So, the first tax planning tip is to figure out what federal tax bracket you are in. The United States has a progressive tax system. That means people with higher taxable income are subject to the higher tax rates, while people with lower taxable incomes are subject to lower tax rates. There are 7 federal income tax brackets: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. No matter which tax bracket you are in, you probably wouldn't pay that rate on your entire income. There are two reasons. The highest tax rate you will pay is determined by your taxable income, which takes into account tax deductions. That's why your taxable income usually isn't the same as your salary or the total income. You don't just multiply your taxable income by tax rate. Instead, the government divides your taxable income into chunks and then taxes each chunk at the corresponding rate. So, for example, let's say you are a single filer with $50,000 in taxable income. That puts you in the 22% tax bracket for the 2025 tax year. But do you pay 22% on all $50,000? No, actually, you pay only 10% on the first $11,925, 12% on the amount between $11,926 and $48,475, and 22% on the remaining account. So the difference between tax deductions and the tax credits. Tax deductions and the tax credit may be best part of preparing your tax return. Both reduce your tax bill, but in different ways. Knowing the difference can create effective tax strategies that reduce your tax bills. Tax deductions are specific expenses you have incurred that can subtract from your taxable income. They reduce how much of your income is subject to taxes. Tax credits are even better. They give you a dollar for dollar reduction in your tax bill. For instance, a tax credit valued at $1,000 lower your tax bill by $1,000. So, taking the standard deduction versus itemizing. Deciding whether to itemize or take the standard deduction is a big part of the tax planning, because the choice can make a huge difference in your tax bill. So what is the standard deduction? Basically, it's a flat dollar, no questions asked tax deduction. Taking the standard deduction makes tax prep go to a lot faster, which is probably a big reason which why many taxpayers do it instead of itemizing. Congress set the amount of the standard deduction, and it's typically adjusted every year for the inflation. The standard deduction you qualify for depends on your filing status. So for the single deduction amount is $15,750. For married filing separately, it is the same as $15,750. For the head of household, the amount is $23,625. For the married filing jointly, it is $31,500, and surviving spouses is $31,500. What does itemize mean? Instead of taking the standard deduction, you can itemize your tax returns, which means taking all the individual tax deductions that you qualify for one by one. Generally, people itemize if their itemized deduction add up to more than the standard deductions. A key part of their tax planning is to track their deductions throughout the year. The drawback to itemizing is that it takes longer to do your taxes and you have to be able to prove you qualify for your deductions. You use the IRS Schedule A to claim your itemized deductions. Some tax strategies may make itemizing especially attractive. For example, if you own a home, your itemized deduction for the mortgage interest and property taxes may easily add up to more than the standard deduction that could save you money. You might be able to itemize on your state tax returns even if you take the standard deduction on your federal return. The good news, tax software or a good tax preparer can help you figure out which deduction you are eligible for or whether they add up to more than the standard deduction. So, keep an eye on the popular tax deduction and the credits. Hundreds of the possible deduction and credits are available, and there are four rules about who's allowed to take them. Here is some big ones: adoption credit, cost of the adopting child; American opportunity credit, college education cost; capital loss deduction, losses on stock sales to offset capital gains; charitable contributions, giving money, cart, art, investment, household items, or the other things to the charity; child and dependent care credit, daycare, and the similar cost; child tax credit, being a parent or caretaker with an eligible dependent; credit for people who are elderly or disabled; for people or their spouses who retired on permanent or the total disability; earned income tax credit, money for the people below certain adjusted gross incomes; electrical vehicles tax credits, tax credit for people who purchase qualifying hybrid and the electric vehicles; home office expenses, a portion of your mortgage rent; property taxes, utilities, repairs and maintenance, and similar expenses if you work from homes; lifetime learning credit, undergraduate, graduate, or even non degree courses at the accredited institutions; medical expenses, unreimbursed medical cost over a certain threshold; mortgage interest, the interest portion of the mortgage payments on a primary home; residential energy tax, installing things that make a home energy efficient; savers credit, contribution to the IRA for people with the income below certain thresholds. The fifth point to know is know what the tax records to keep. Keeping tax returns and the documents you used to complete them is critical if you are ever audited. Typically, the IRS has 3 years to decide whether to audit your return, so keep your records for at least that long. You also should hang to a record for 3 years if you file a claim for a credit or refund after you filed your original return. Keep records longer in certain cases if any of these circumstances apply. The IRS has a longer limit on the auditing you: 6 years if you underreported your income by more than 25%; 7 years if you wrote off the loss from a worthless security indefinitely if you committed tax fraud or didn't file a tax return. So here is the expenses and the deduction receipts, invoices, alimony paid or statement from charities, gambling losses, home closing statements, purchasing and sales invoices, insurance records, retirement accounts, and the other investments include transaction data, including individual purchase or the sale receipts, and then their annual statements that are all included in the other investments. So that was all about the topic. Hope this topic will have been beneficial for you. So do subscribe the channel for more videos. Thank you so much.